Welcome to Dr. Fred Markets. This is not financial advice. Most people will never understand how crypto, AI, and global finance are reshaping the world. The rules are changing, and the ones who adapt early come out ahead. You're here. You're paying attention. That already makes a difference. Let's go.
Markets pay UFC fighters more than fans do. Signal 1. Sports betting handles on UFC events now smash $50 to $80 million per big card. But the real juicer is the trading volume in the listed sportsbooks, DraftKings, Caesars, MGM, spiking 20 to 40% around fight weeks while your boring index funds nap. Signal 2. Gaming stocks quietly doubled down on real money betting. More than 30% of their revenue now comes from turning your adrenaline into continuous cash flow. And options volume around major fight cards jumps as hedge funds treat sports weekends like mini Fed meetings. Signal 3. Regulators push U.S. sports betting legalization across more states, taxable revenue rising over 60% year-on-year, while traditional market volatility compresses and day traders flee to dopamine-rich apps. Yet almost nobody treats this as an investable macro signal. Here's the cliffhanger. UFC at the White House and a massive PPV weekend just flashed the same pattern I watched in 2020 around stimulus checks. Except this time, the stimulus is violence and Vegas math. The connection: fight nights are no longer entertainment. They're leverage events that rewire retail risk appetite, move gambling stocks like microtech rallies, and shape how the next market mania forms. You either read that signal or you become the signal. Let's break the mechanism. First, attention is the new central bank. A UFC card doing 1 million PPV buys concentrates millions of eyeballs into a 4-hour window. Online sportsbooks love this because their unit economics are disgusting in their favor. Long-term hold for the house, roughly 5% on sports bets. If 1 billion total handle crosses UFC-related markets globally, that's roughly $50 million of theoretical edge being harvested from human overconfidence and under-research. Now look at markets. DraftKings IPO'd at joke levels, got memed, crashed, then clawed back as legalization spread. Each time a new state legalizes online betting, long-term revenue estimates ratchet up. The stock trades like a leveraged ETF on your bad parlay decisions. Big weekends like UFC Freedom 250 are free marketing. Bet slips clog X and TikTok. New accounts surge, and retention tightens because I almost hit a plus 900 parlay is the new lottery ticket copium. Second, sports bettors and new retail traders are the same animal. Same apps, same dopamine curves, same language. During COVID meme stock mania, Robinhood screenshots ruled. Today, FanDuel slips run the same script, tiny accounts chasing huge multipliers. But here's the twist. Sportsbooks hedge risk in real markets using options and sometimes trading-related equities, while degenerate bettors stay raw and unhedged.
Let's pause for a second. Ask yourself this. Do you really understand what's happening in the markets right now? Do you know how this affects your money, your savings, your future? Most people don't, and that's exactly why you're here. Let's keep going.
That flow feeds Wall Street data. The smarter funds scrape betting markets to read real-time sentiment faster than any consumer survey. Third, UFC at the White House is not a cute culture moment. It's political validation of legalized speculation. If the presidency gives cage fights and betting-friendly spectacle a patriotic stamp, the Overton window for risk-taking widens. That spills into markets. People trained to think it's normal to stake tonight's paycheck on a head kick will not blink at weekly options on Nvidia once they figure out the interface. Here's the non-obvious thing you learned today. Sports betting adoption works as a leading indicator for retail risk on-off in equities. When handle, sign-ups, and promo spending on betting apps surge, we don't just get more parlays, we get a new batch of people learning the emotional cycle of FOMO, fantasy payoff, brutal loss, double down. Once they graduate to options, they drag that behavior into actual tickers. So what do you do with this? Not financial advice, just truth. 1. Treat sportsbooks and gamified gaming stocks as a volatility barometer. Huge promo burns, new state launches, and record handles usually mean we're in a culture phase of gamble on anything. Equity speculative pockets, small caps, junky tech, sketchy biotech tend to catch that same fever. 2. Stop being the product. If you gamble on fights, track every dollar for 1 month. calculate your house tax by comparing total bet volume versus ending balance. You just reverse engineered the Sportsbooks implied yield from your behavior. Now compare that to the profit margins of DraftKings or similar names. You're training yourself to think like the house, not the mark. 3. Use big fight weekends as discipline tests, not action triggers. If you feel the itch to bet every main card, park that money in a boring, pre-decided investment instead, an index ETF, a debt payoff, whatever your strategy needs. You're converting a high-variance dopamine leak into a low-variance compounding engine. Fight nights are volatility carnivals. UFC sold the world the illusion of one punch away, while the house quietly earns 5% off every emotional swing. Markets work the same way. The story changes, but the math never does. So either you learn to read events like UFC Freedom 250 as macro sentiment signals, or your portfolio becomes another highlight reel for the house. This is not financial advice, but it is a demand. Stop pretending entertainment is separate from markets. Every bet, every parlay, every just-for-fun flutter is part of the same system that mints the next DraftKings billionaire. Learn the math. Own the casino stock, or at least respect its edge, because the guys bleeding in the cage are not the only ones paying to be there. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's a wrap for today on Dr. Fred Markets. I hope this gave you something to think about, a new angle, a clearer picture, a better question to ask. Remember, this is not financial advice. Do your own research, always. If this video added value to your day, subscribe. It's free, it takes 2 seconds, and it's the best way to support this work and keep it free for everyone. You'll also find every video as a full article on the blog, drfredmarkets.com, and the newsletter is in the bio. I'm Dr. Fred Markets. See you in the next one.